Okay, well, thank you for joining today's webinar. We're excited to share the new tools we've developed and the enhancements we've made to the existing ones on the website. We realize we've added a lot of new features, so today's webinar aims to ensure you have a better understanding of how to use the website to enhance your research process. I'm going to use two of our pre-submitted questions from subscribers as a guide for today's webinar. Those questions were, what is your go-to list of things to review each morning on the site? And two, I want to see a step-by-step guide on using essential tools during the webinar. So these two questions fit very nicely together, which will help us to understand, how we can use the website and the new tools that we've developed and enhanced on the website. So let's jump right in and talk about, what's the first thing I sort of look at when in the morning when I want to get just sort of a broad assessment of what's going on in terms of the market. Are we on risk on mode or risk off mode? And one of those tools is our proprietary risk on, risk off indicator, which you can find under the spotlights section on our website. If you just click spotlight on Sentiment, it'll pop up. And of course, what you can see is the broad composite at top, and then a thumbnail chart for each of the indicators that are included in this composite. As a reminder, there's 21 of these sentiment and breadth-based indicators. So a good comprehensive view of what's going on in terms of the overall market. A couple important things to note. We did just recently make a change, which we announced this morning. We no longer had access to the analyst price target indicator data. So therefore, we had to replace that component within the broad risk on risk off composite, and we elected to use the PE VIX spread, which you can see here in this thumbnail chart. At the end of the day, we probably don't think it's going to really move the needle that much. Again, there's still 20 other indicators out there, but with that change, again, we left the historical record that indicator in place, and now we're just updating it with the new one starting on September the 19th. So again, we don't really think there's going to be much of a change there. The second change that we made that's important in terms of the risk on indicator is that we moved the threshold levels for the composite. So prior to now, the main threshold level was just 50%. If you were above 50%, you're in risk on mode. If you were below 50%, you're in risk off mode. And after we did some historical testing, we realized that there's better threshold levels. And I've mentioned this a few times in my research notes, in terms of these other levels. And again, what we found is when the risk on off indicator rises above 67%, you're in risk on mode until it falls below 35%. You remain in risk off mode but as long as it remains below 67. So those new threshold levels, just an example in terms of that data. When you're in risk on mode using the new 67-35% brackets, $10,000 grows to $29,000. If you use the 50% threshold, the 10,000 grows to only 23,000. So, you've got a better growth of $10,000 by using the 67-35 versus the 50% threshold. Equally important, right, is that using 67-35, you only had 38 transactions since 2000. If you use the 50% level, you had 164, okay? And just another small example in terms of that 164 transactions between the end of April of 2023 and the end of May of 2023, the indicator crossed above 50% 10 times. So just think about that. In a 1 month period, which is typically 21 days, you're in risk on, risk off mode 10 different times, which, again, if you're a systems person, you're a strategy person, that's the kind of thing that you want to avoid. So again, we made this change. Doesn't mean you have to use it. You can still use this indicator with the 50% levels and use that as an overlay in our backtest engine. But we felt like it was time that we changed that. All right, now look here again. Let's give it an example. Hopefully everyone had a chance to read my note yesterday on the McClellan Summation Index. How did I find that idea? Well, by browsing the risk on risk off indicator. And what you can see is in the thumbnail chart down here, I was looking at that on Monday afternoon or Tuesday morning, and I saw, oh wow, it's risen above 1,000. That's a pretty extreme level. So I was like, well, let's go test that. And of course, using the BackTest engine 2, we can then go and test and see what happens on a forward return basis when the McClellan summation index rises above 1,000. So very simple. Just click on the McClellan summation header. That'll take us to the chart. If we click all, we can sort of get a general sense here of what happens when that indicator rises above 1,000. And what you can generally see is a high level above 1,000 typically initiates a new up move in the market, or it signals just a continuation. So whether it's a bear market or a correction, what have you, generally when this indicator rises above 1,000, that's a pretty good sign for the broad market. All right, so how can we test that using one of our new tools in the Essentials plan? Well, if we scroll down, we can click BackTest Engine 2.0 and bring up the new BackTest engine. And again, what we have in here is you'll get, again, a chart, and it just takes a few seconds here to load. But what we provide here is a chart, and then with the indicator plotted in there, as well as, a setup in terms of how do we want to set up this to test whether a cross above 1,000 is bullish or bearish for the market. If we scroll down here, we can sort of see the setup, and generally speaking, I tend to leave all these in place. What I will do is I'll just name this. So what you can do is just name this McClellan. Excuse me. Summation, and then cycle from less than 100 to greater than 1,000, which is basically what I showed yesterday in my research note. All right, so now that we have a name for it, we're going to use one of our new functions, which is the time order multi-condition. In our previous BackTest engine, you could only do single conditions. So this is a new added feature that is really beneficial for testing market indicators. So if we click on that, we can see sentiment indicator, McClellan summation. And what I'm going to do is just say, let's cross below 100, which the McClellan summation did, not too long ago, a couple months ago. And then for my second condition, I'm going to type in here, McClellan, and then summation. I'll select that. And then what we're going to say is we're going to cross above 1,000. Okay, I'll leave time and market as is, because we'll see those multi-time frames, and then we'll quickly just click the run BackTest engine. Well, let's do this. Why don't we can let that run, and then we'll move on sort of the next area. So one of the other areas that I look at in the morning is the spotlight on breadth. And of course, this page gives us sort of a comprehensive view of market breadth indicators for domestic indexes and sectors, as well as foreign breadth. And of course, you can see in here, we've got the McClellan summation as an indicator. We've got the panic breadth composites that Jason uses in his notes. We've got the 80, 10-day AD ratio, which is also very popular, what they call breakaway momentum. And of course, just things like new highs and new lows. So this is another good resource where, you can come in here and quickly look and assess, okay, well, what's showing the highest level of 52-week highs or 52-week lows. You can quickly just hover over one of the indicators. It'll give you that sort of chart that you can then see, all right, well, is this in an extreme level, and then of course, if you want to, you can click through and pull up a more broad chart here, look at all the history. And again, once again, we can click on our BackTest engine, and we can go through the same sort of process that I just walked through with the McClellan summation index, where, that we can then go test a trading or investing idea. Let's take a look at the spotlight or at the strategies page. Again, this is another one where we've we've added new strategies, we've categorized them, and we've provided everyone with really a more comprehensive overview of what's going on in terms of sectors and factors. Most of these strategies, use momentum or relative strength to identify what's leading or lagging the market. And again, could you use these as actionable strategies? Yes, but they also serve a dual purpose in terms of giving us a market message. So, for example, if we look at the what's going on with sectors, we can see that, well, consumer discretionary just moved to a buy signal. Okay, well, if you've been, reading some of my notes of late, there's two things I've really shown. Like, one was interest rates coming down and then crude oil coming down. Well, that benefits the consumers. Now, we do have to be mindful that the discretionary sector is highly influenced by Tesla and Amazon. But again, this just gives you a starting point to say, oh, wait, what's going on with consumer discretionary? Dean wrote about, rates coming down, oil coming down. That should be favorable for the consumer. Let's go investigate further in terms of what's going on with this sector. Another just point to make here is, when we sort this, and I pointed this out in a research report, until this discretionary, sort of signal, the backdrop had been very defensive. We'd had consumer staples, real estate, utilities, healthcare, all on buy signals in terms of relative strength. And again, I had mentioned in a research note that I suspect that with rates coming down, these sectors caught a bid. Recall as rates were moving up in 2022 into 23. These sectors got hammered. They're typically, say, for higher dividend yielding stocks, and when cash went to 5.5%, people said, well, I'll just take 5.5% versus the risk of a 3% dividend yield in a consumer staple stock that might be expensive. Now that that's reversed, it'll be interesting to see if we start to see these move off of relative strength buy signals, and we see more cyclical oriented sectors, take over leadership. Again, factors, I pointed out in terms of the factors, we saw value trigger a buy signal, so it's now long value, and it's long value across, all market caps. Interesting, it's still long the S&P 500 relative to the equal weight S&P 500. But again, this provides just sort of valuable insights into what's going on in terms of the market and relative strength. Bonds is another good category here. Again, we compare, I believe there's like roughly 10 bond categories here. We're comparing it to cash. Is something outperforming or underperforming cash? And you can see right here, every single bond category is on a buy signal versus cash. Now, if you go back and you look at the history in 2022, every single one of these was on a sell signal versus cash. Okay, as we know, rates were rising and cash was outperforming all these bond categories. So again, these give you, good insight into what's going on, and again, you could also use them as an investable strategy. Just as an example, the large cap growth, if you go into the large cap growth, and you look at this, I think it's out, the growth has outperformed the S&P over like 10 straight years, switching back and forth between growth and value. So valuable insights along with actionable, strategies. And this is another area that when I come in each morning, I'm going to look at this. If you want to, and again, one of the new tools on the website is our new strategy page. So you could come into the strategy page. We've got all the same strategies in here. And say you wanted to adjust some of the parameters, that's where you can do this now. And again, in here, we have a longer history in terms of ETF data. So listen, it's important to understand what the ETF data is it doesn't reflect the dividends. So, if you look at some of these, compound annual growth rates, it's not taking into consideration dividends. So it may be lower if you're looking at like an index. But another new area of the essentials package where you can come in here and adjust parameters for these strategies. Now, just as an important point to note, especially with these relative strength strategies, when I went and back tested and optimized the thresholds, I used index data going back to the 60s. So, you may not want to adjust those thresholds. Those have been time tested across, 50 plus years, whereas the ETF data we have in here, I think goes back to like 2000 or so. All right, so let's go. Well, for some reason, this is still running, which I'm not really sure why.
Dean, are
There
you
we go. All right, hold on.
oh, did it come up? Okay, good.
Yeah. Okay.
There we
All
go.
right. Good news. All right. So if we come into our results, and what we can see here is again, what I like to look at is the exit with the different time frames. And again, what we can see here is exactly what I showed in the note yesterday is over the next 6 and 12 months, really good positive win rates, max gains that significantly outweigh the max loss, very high Z scores. Just to review, the Z score looks at the signal returns, compares them to random returns, and if it's significant, it's above 2. And so that's what you want to see when you're analyzing historical price patterns. All right, so listen, one of the questions that we got from the subscribers was, how can sentiment indicators be used to identify potential market levels? Well, look, that's a very difficult thing to answer, but what you could do is take a look at this outlook table. And what you could say is okay, based upon this McClellan summation index, the S&P should rise roughly 4.2% over the next 2 months, or 8.3% over the next 6 months. And you could say, all right, well, if we extrapolate that, that means the S&P could be at this potential level. So that is one way that you could say you could potentially assess. And if you have a bunch of these signals, and they're all saying positive things about the market, you could generally get yourself, a somewhat of a level, and then you could just track the market. You could say, all right, well, this triggered, and the S&P should go here. How's the market actually reacting based upon what it should be doing? Is it underperforming? Is it outperforming? And that'll sort of give you a general idea. Just to tie that in with with our archiving of our research notes. Let me get back to the dashboard, and well, let's go look at tools. Archive studies.
Dean, sorry to interrupt.
Yep.
We have some questions in the Q&A regarding to what you just said. Do you mind take a look at that?
Where would that be?
If you go into Q&A.
Okay, there it is. Okay.
There you go.
Okay, are you using a comparative rate of change analysis to determine the range rank of various asset groups? I would say no, but I'm not really sure what is being asked there. Can you guys also include an average return as well as average return for the signals in question? Yes, we're gonna. So here's the deal. In our notes that we publish, we don't have that in there. We do have average return. We do have median return. That we'll add all that to the website. It's easier to view on the website. We can also put in those random returns. And I've talked to Jason about this, in our tables for the notes, the more we add, it's a constraint in terms of space. But I on the website, yes, we can add pretty much anything we want. Is there's just more viewing space for that. Can you comment on the TCTM model? Yeah, listen, I'll address that a little bit later because there is a question in terms of of what technical indicators we should use to highlight sort of risk off periods. So let's sort of go back and finish up, and then we can come back and address these questions, I think, more towards the end. And Jay can chime in on this as well. So I'm going to click off on that. And again, but I wanted to just quickly touch on the active studies. And we're right now working on a project where one of the complaints that we've gotten from subscribers is all right, well, we produce a note and it has a forward return outlook, and then we don't know what happens after that. So to address that, we're undertaking a project, and we're still in that process, but we're going to take those signals and then we're going to track them on the website so that a subscriber can come in here and they can see, all right, well, Dean just put a long-term focus on this, and let's see how it's performing, based upon the analysis. And then once we do that, not only will you be able to see that, okay, well, yeah, these signals are working, but then we can sort of roll it up and provide some great value in terms of looking at maybe rolling 1 month, 2 month, 3 month periods where we can say, well, the percentage of our bullish medium-term forecast, are exceeding the performance, 50%, 60, 70, 80% of the time. And then that will allow us to give us a general sense of like, are things performing as they should, or are they underperforming as history? And then if they're underperforming, right, then that gives us sort of a benchmark to say, okay, well, why are they underperforming? Is there some sort of macro factor out there that is potentially causing the market to do something that it shouldn't be doing? So again, I wanted to just touch upon that. We're still in the process of refining this, but I think that subscribers will find this very valuable in terms of what's going on, in terms of how are our signals doing on a go-forward basis. Okay. All right. So let's just go back to, we've touched on strategies. We've touched on, let's just talk also something that we're working on right now. And, again, if we look at, let's go look at, and again, this will lead into it, but let's go look at the, let's see, tools, and then where is it? The correlation pattern match tool. So this is a new tool, that we added to the website not too long ago. And I mentioned this crude oil example in a research report not too long ago. But let's just take a look at crude oil. And this is just an example that I was looking at, when I was looking at crude oil one day, and I'd seen, oh wow, crude oil has gone up a significant amount. And the time frame that I was looking at was right here. So this sort of period between June of 23 and September of 23. So sort of a multi-month period. And I said, all right, well, look, let's use the correlation pattern match tool to find other periods in history when crude oil has acted similarly to this. And again, this is very easy to set up. Again, you can come down here, you've got your start date, you've got your end date, or if you want to use the number of bars, you can do that. For this example, I said, all right, well, let's look and see what, crude oil, this pattern between June of 23 and September of 23, and see what's happened. And then we can get an example. Like we can see, oh, wow, well, look at this. Anytime crude oil has had this multi-month run like it had experienced over that time frame, there's a good chance you do not want to own crude oil. And again, you can do this, with anything we have on the website, whether it's the S&P, crude oil, other commodities, what have you. And this gives you a starting point, and then you can use our other indicators, right? So, you could come back and you could say, all right, well, look, crude oil's just had this big run. Let's take a look at the commodity indicator list. And let's take a look. Crude oil. All right, so we've got all these, various sentiment-based measures for crude oil. And we can see, well, it's had that big run, right? And this is reflecting current day. But again, this is just an example of how you can use the website. You could have come in here and you could have looked at all these various sentiment indicators. And the reason why I want to mention this is because we're conducting another big, broad study right now. And we're looking at every single indicator that we have on the website. And what we want to do is find, threshold levels across different, sort of deciles and provide that on the website. So the sentiment bars, which, again, we've gotten complaints of, well, it just doesn't tell me anything. Yes, it tells me sentiment is optimistic. And when, sentiment is optimistic, we need to be mindful that a given market could reverse to the other, to the downside. If sentiment's pessimistic, it could reverse to the upside. But the goal here is to provide you with those threshold levels, which you see in our charts, right? So if above this level, crude oil is going to annualize this. If below that level, crude oil will annualize this. That will give you a much better framework to say, oh, wow, we just had this multi-month run. Now we're seeing all of our sentiment indicators showing negative annualized returns. Therefore, I don't want to be long crude oil. And if I'm long energy stocks, right, there's probably a good chance we don't want to be long energy stocks if crude oil is going to go down. So again, this is another example. We're in the process. I can't tell you how long it's going to take, but I will say this, Hal and his team of programmers are very responsive, very good. And, they can turn things around very quickly. So this is just another example of how you can use the website and the tools to help you gain an edge in the market. Okay, so that's sort of generally the three, 4 main areas that that I wanted to touch on today in terms of just how we can use the website. And let's just go quickly. What I want to do is just kind of address some of the questions. And then what we'll do after that, we'll take questions from subscribers. So let's just flip through here. And then can we export data and views the strategy tools triggered? No, but I will say this, that's an easy implementation. We already do that with the BackTest engine too, where you can export all that data. The go-to list, again, I just showed you some of those things. Potential market levels, again, we touched on that in terms of looking at what the outcome is for a signal and how that can sort of give you a general sense of where the market should be headed. All right, what is the best way to anticipate bear market using technical analysis? Look, for me, my TCTM risk warning model, which you can find on the website. If you go to Spotlight's TCTM, what I've found is market breadth, and in particular, 52-week lows are generally the best technical indicators to monitor if you want to, assess whether we're potentially entering an unfavorable period for the market. Look, it doesn't work every time. Okay. If you go back and you study history, there have been periods in time like, the 68, 70 bear market where there was no advanced warning for market breadth. But generally speaking, market breadth is the best tool, and 52-week lows, which is, again, a big component in my composite risk warning model. That's going to provide you sort of with the best early warning. And again, what you're trying to do is give yourself a heads up alert that there could be a potential trend change. Doesn't mean that there is going to be a trend change, but if we can in advance of that trend changing, we can reduce risk. That's a very key and important thing to do ahead of especially devastating bear markets. Jay, do you want to quickly jump in and just provide a few things in terms of what you
Sure.
look for?
Sure. In terms of market tops, just know that it's really hard to predict a market top because they usually take time. Very often a market will bottom out very quickly, but those tops take a while. And Dean makes the point about breadth. Typically what happens at a bull market top is some stocks start going down while the major averages continue to creep higher. So people, especially people in index funds, go, well, the market still looks pretty good. The S&P is up a little bit, the Dow's up. Meanwhile, half of their stocks are starting to fall down. So that's the point that Dean makes with the breadth. Another indicator I'll mention that I look at for kind of a heads up on that is the NYSE High-Low Logic Index. If you make a note of that, usually I use like a 10-day moving average. And basically that's the same kind of thing. It looks at churning in the market when there are a large number of new highs and new lows. That can be a warning sign. Ideally in a bull market, you get a lot of new highs and just a handful of stocks making new 52-week lows. Whereas when the market starts to reach a top, you start to see a lot more of both or a similar number, and that's a good sign of churning. The other thing, forgetting about predicting, is just keep an eye on the major averages, and I'll mention the S&P, the Dow, the mid-cap 400. I also look at Russell 2000. Look at that 200-day moving average. Everybody follows it, and it seems like such a simple, obvious thing. But as long as all of those indexes are above the 200-day moving average, even when you start to see that churning, you still might want, if you're an index fund, you still want to give the market some leeway. Once those indexes start to drop below their long-term moving averages, it's time to play some defense, in my opinion. And every once in a while, you get whipsawed, and an index will drop down below that average and then turn right back around. But that's kind of the price you pay to avoid riding the major bear markets all the way to the bottom. Yep. So I'll leave it there for now.
Yeah. And again, you guys will hear it over and over from Jay, Jason, myself, using a weight of the evidence approach is just imperative in market analysis, and, relying upon one single indicator is very...
Can I jump back?
Sure.
Can I jump back in? So yeah. I'm sure a lot of you guys spend time on Twitter, and the thing that drives me crazy is when I see somebody go, oh my God, look at this indicator. And it's just this one indicator in an ocean of indicators that happens to be giving a bearish signal that once or twice before, worked pretty well. But the weight of the evidence, as Dean mentioned, is really what you want to focus on, not just something that looks scary today on Twitter.
Right. Back to you. Perfect example of that is the recent note that I wrote about crude oil and interest rates, declining near the bottom end of their 1-year range. That came straight from Twitter. I mean, it's unbelievable. They're, very well respected macro people on Twitter who are sitting there showing that chart and talking about the big alligator mouth, and saying, oh, well, crude oil is, signaling a depression. And yet they don't show any evidence, to collaborate or, to corroborate their point. So, hey, if you take one thing away from today, be very careful of who you pay attention to on Twitter. We would prefer you listen to what we have to say. We use this weight of the evidence, evidence-based research approach. And
if I can throw one more in there, the yield curve, everybody watches the yield curve, and somewhere between 18 months and 2 years ago, it became inverted. And ever since then, there's people just saying, well, it's obvious we're going to go into a recession because the yield curve is inverted. And here we are. So there are no perfect indicators. I think that's a real important point.
Correct. You guys have seen it. I've mentioned it in notes. There's a quote by George Chestnut, former money manager back in the 50s and 60s. And that quote is, the most reliable forecaster of market action is the action of the market itself. And, if you had to
True.
use one quote to describe what we do at SentimenTrader, I think that one would be right up there near the top. All right, let's go back and just kind of touch on some more of these questions. Okay, trend scores. Yes, it's in the queue. We're going to add those. And then again, what we'll most likely would need to decide, we'd probably have an individual. What I'd like to do is have a page where we have the S&P 500, the NASDAQ 100, S&P 1500, and then you can review those trend scores on an absolute relative basis. And then, the 5-day net change, which you've seen me mention several times in research notes. One of our questions we got was about, swing trading, and the 5-day net change is a real good swing trading tool. So we'll probably, have some sort of, page where you can, identify those. And then you'll also be able to, test that stuff in the BackTest engine 2.0. And so, if there's key indexes that, you watch on a daily basis, you could set that up and look for those trend change scores. So just to touch on that, will inflation be added as indicator of factors to the platform? Jay, didn't we add one of your inflation models somewhere?
Yeah, I think it has to do with one with the producer price index.
Okay.
Yeah.
Yes. So to answer your question, I've got an inflation indicator that uses CPI. So I think it would be good to have those. Where we'll put them, I can't answer that right now. I will touch on that. If you go back to the strategies page, what I want to do in there is add another category for risk on, risk off. And, I've shared, the financial conditions strategy, several times in research notes. We had to get permission from Goldman Sachs to put that on the website. Now, we will not put the raw data on there, but we will put the strategy on there. And that would be one of the first ones that, I'll have Hal program. But again, what we could probably do is maybe put some of Jay's inflation models in the risk on, risk off category. And again, so what you'll be able to do is go in there, click on that category, and then just see, oh my gosh, we've got 10 models in here and 9 out of 10 are in risk off mode, providing you with, good information in terms of what's going on with market conditions.
Yeah. If I can
finally, will the portfolio
okay.
analyst tool be relaunched? I would say for now, no. Again, just as a reminder, Jason ran that for several, maybe 2 decades. It was his personal money, and he wanted to do something else with that. And again, what I would just say is pay attention to what's going on in the strategies, and that'll give you a pretty good sense of, again, what's leading and lagging. And if we do add risk on and risk off as a category in there, that's just going to give you more information that'll probably help you in terms of your own portfolio and what you should own or not own. Okay, so that does it sort of for the pre-submitted questions. So why don't we go back to the Q&A, and let's touch on some more of these. So we touched on the TCTM. In terms of median average return, yes, we can add that to the website. And again, we can add the random return so that you can make a comparison. But just, look, just to give everybody a sense, the Z-score in our Outlook tables that we provide in the research notes and on the website, again, it takes into consideration what the return is for that signal. It compares it to the random return over the study period. It also takes into consideration the number of signals, so that gives you a pretty good idea of like, is this significant or not? Should we be paying attention to this signal? And so, when I publish a note, and Jason or Jay, look, we're always trying to provide an edge. Jay will show you in terms of his growth of a dollar of, from point A to point B, here's what the dollar grew. And in risk off mode, here's what that dollar did, and you can visually see that. Again, the Outlook tables do the same thing, and the Z-score is what you really want to pay attention to. in terms of does it provide an edge? Sometimes we may provide something where there isn't, significance in terms of the Z-score. And again, that's just more of, hey, here's an insight that we thought was interesting and maybe pay attention here. Okay, let's keep going down here. Can you help us better understand how to interpret the smart and dumb money confidence chart? Jay, do you want to touch on that one?
I'm sorry, run it by me again.
So the question is, can you help us better understand how to interpret the smart money and dumb money confidence chart?
Well, probably the best way to do it is to look for some of our previous articles that we've written on that topic, because it's a very useful data series, but it's not an automatic trading system where, okay, when this value reaches X, you buy, and when that value falls to Y, you sell. So it's a little bit nuanced because most sentiment indicators, to put it in the broadest way possible, tend to be correct in the middle and wrong at the extremes. And that's really the way to look at it. So when we get when we don't have an extreme reading, we basically want to pay attention to the market trend and just stick with that. And then when those indicators start to reach extremes, that's when you want to start to question the market trend, start to look for that churning, start to look at the market versus the moving averages. But as far as the specific numbers on dumb money, smart money, to be honest, I'm drawing a blank. I've written about it. Dean has written about it some, and Jason, of course, has obviously done a lot of work since it was his creation. So I would take a look on the website for some of those older articles on that.
Yeah, and a good article that Jason just published recently was looking at the risk appetite indicator, and that provides good context in terms of how to use sentiment indicators. So again, what Jay was saying a lot, what you do is you look for it to go to an extreme, either super optimistic or super pessimistic, and then a reversal from that area. And a lot of times what you'll see is sentiment in a bull market will stay elevated. But when the market's rising and that sentiment continues to tick down, which is what Jason showed, that's when you need to be real careful. And so why? Well, think about it. Again, when it's high and elevated, people are bullish. Their tendency is to hit the buy button more. When you're bullish, you hit the buy button, right? But what happens is, as people start to get more pessimistic, and then all of a sudden the market starts to correct, well, boom, now they're hitting the sell button, and that's when there's danger. So a lot of, again, just has to do with investors' mood, and when they're bullish and sentiment's optimistic, that's when they're buying. And then when it goes the other way, that's when they're selling. And then again, it moves to these extremes. But again, check out Jason's article. I think that's a good one that sort of ties into how sentiment generally works across, most indicators. Okay, so let's see here. Why not just use the composite risk warning model? Yeah, good question. If you're a long-term investor, that's probably all you should use. We got, and again, I think what Jay Leonard here is saying, I have a shorter term model, and that one got tripped up, back, gosh, I don't remember, a couple months, 2-3 months ago, and we got what was called a whipsaw signal, and again, just depending on sort of your risk tolerance, what I would say is yes, if you're a long-term investor, just use the composite risk warning model. If you're a short-term trader, then I want to have some more of those shorter-term oriented indicators that tell me, all right, well, geez, we could get a reversal. Doesn't mean we're going to get a reversal. Very important when it comes to these composite models too, which I do with the TCTM, is once you get to a threshold that says, hey, here's a warning, you still should use trend. right? What sort of, level or, again, do I use short term, medium term, long term? That's a whole nother question for another day, but you should still use trend, because what a lot of times, and I do that, right? I use rate of changes. So if you got a signal, but the market just keeps going and the rate of change never turned negative, well, we wouldn't exit the market. So it's really important to use those in conjunction with the composites. And again, you could do that with the risk on, risk off indicator on the website. Is if it were to fall below 35% or 50% or whatever level you want to use, you could then add one more condition to say, well, the S&P 10-day rate of change has to be negative, and then we'll exit the market, or not exit market. Maybe you take a little bit off. So good question there in terms of, again, remember, everyone has different risk tolerances. Everyone has different time frames that they're investing across.
Yeah, if I can expand on that a little bit, I was just thinking that. So a lot of what you're going to look at on the website depends on what you do normally. So in other words, if you're a longer term investor who is usually mostly fully invested, your real focus is just going to be the bigger picture and also where the money is being made. In other words, relative strength among sectors. Some of the things that Dean showed you earlier can make a huge difference in your return. If you're in technology versus utilities, during a bull market, you tend to do better. But if you're a shorter term trader, there are a lot of different indicators on the site that you'll be looking at that are more overbought, oversold in nature, where you're kind of looking to buy either on weakness or preferably for me personally on a reversal after a period of weakness. So that's just kind of, you have to kind of look at how you are doing things. For my own use, I have an investment account and a trading account, and it's essentially the same thing, but it's a different point of view. One's longer term, and one is how do I make money in the long run, and the trading is how do I make money right now. So that's going to guide what indicators you're going to look at.
Okay. Well, so if we don't have any more questions, we've got roughly 8 minutes or so, and obviously we can run over if need be. But so just let me just I'm going to give sort of my 2 cents worth on the market, and then Jay will give his sort of 2 cents worth, and and then if there's any more questions, we can answer that. So I'm constructive on the market. We've seen enough evidence, whether it's price momentum or breadth or what have you, that we're in an uptrend. That doesn't mean that we're probably not going to get some sort of consolidation dip ahead of the election, which I've shown in a few notes here and there. But the backdrop, still looks constructive to me. The weight of the evidence is still bullish. Again, we get asked this a lot of times. Oh, well, you guys, y'all only, really show bullish things, but hey, look, the market goes up a lot more than it goes down. So, you should be seeing more bullish studies than bearish studies from us over the course of a market cycle. And but again, I remain constructive. Can't rule out that we get a consolidation or a slight dip ahead of the election. But for now, things look good. Jay?
Yeah, I'm in the same camp. And one thing to realize about what we write is Jason and Dean and I, we're analysts, not advisors. So basically our job is to be as objective as possible in what we see. We look at the data, and it's always backed up with a table and charts so you can see for yourself. So whether we personally are bullish or bearish is not based so much on our opinion as it is what we see among the indicators that we focus on. And everybody focuses on different things, which is why different people see different things. But as I've been saying on Twitter a lot lately, the stuff I follow is bullish on stocks, so I'm still bullish on stocks. It almost seems like it's getting too good, in my opinion. I keep kind of waiting for a pullback, and it just doesn't seem to want to come. I'll be writing in the next couple of days or possibly next week about one thing to keep in mind. October 1st of the election year, I'm sorry, let me rephrase that. October 1st of year 4 in a decade through March of year 6 in a decade has never been down. You go back, I took the Dow back to the 1800s, that period that it's I believe it's an 18-month period. It's never been down. So all that tells me, obviously there's no sure things in the market, but what it tells me is to give the bullish case the benefit of the doubt until we see, as we talked about earlier, some churning or the indexes actually start to turn down. So in the meantime, still bullish. What can I say?
Okay.
This sounds like a sell signal to me, but let's not go into that.
Looks like we don't have any other questions. Look, if you think of something, after we hang up here from the webinar, just shoot your question to, admin@SentimentTrader.com, and then we'll do our best to get back to you as soon as possible. Look, we realize, that we didn't probably get to everything that people wanted to see today. But we're going to have more webinars, and Jay will be hosting the webinar next month, October 23rd. So hopefully we can cover more topics that we didn't cover today in terms of how Jay uses the website and his research process and some of the new tools. And again, please, if you can submit questions prior to that webinar, then we'll make sure that we address those. And I'll be on the webinar just like Jay is today, but Jay will be the lead. And we hope you can join us. And we just want to thank you for being a subscriber.
Yeah, thank you. Thank you very much for subscribing and for joining us today. We appreciate it.